Welcome to Life Happens, where Texans come to protect their legacy and prepare for the second half of life. Join your host, attorney Kim Hegwood of Your Legacy Legal Care, and our weekly guest as we navigate the challenges that emerge as life happens. Now here's your host, Kim Hegwood.
Good morning and welcome to Life Happens with me, Kim Hegwood, and our very special guest today is Michael Ritchie. Good morning.
Good morning, Kim.
So today we're going to talk about how you stretch your retirement dollars while staying at home. And just so in case that didn't tell our listeners what we're going to do today, we're going to talk about reverse mortgages. And so Mike, can you tell our listeners what a reverse mortgage is in as simple terms as you can do?
Sure. Well, a reverse mortgage is just a mortgage. It's different than the traditional mortgage that most people are familiar with. We call them forward mortgages. The reverse mortgage is just a way for seniors to access the equity in their homes. The intention is to allow more seniors to age in place, if that's where they choose, of course. So the reverse mortgage allows you to access that equity when seniors are less able to access that equity in the traditional ways, such as a home equity line of credit or a home equity loan. It's difficult for them to qualify for those loans, and they may have no other alternative besides selling the home in order to get the equity out of their home. And that's just not a good solution. So that I think is the simplest way to explain it. It's sometimes the only way, practical way, for seniors to get access to that equity that they desperately need.
And so, but it's funny because most people hear, reverse mortgage, and reverse mortgages have gotten a lot of bad reputation over the years, so why do you think that it has happened?
Well, it's kind of the nature of the situation with the reverse mortgage. Once you get this loan and you get the access to the cash, you don't have to make any monthly payments. That loan amount grows with time, but the borrower does not have to repay that until it becomes due. And it becomes due if they move from the house, or if they sell the house, or they pass away. But the borrower is still required to pay property taxes, home insurance, HOA dues if they're in place. And so once you've run out of all your funds and you can't pay your taxes, well, then foreclosure ensues. And that, of course, happens if you own the home free and clear. If you run out of money and you can't pay your taxes, you've got a problem. So oftentimes that happens, and it's inevitable whether the reverse mortgage is in place or not. But of course, the reverse mortgage is going to get credit in the eyes of many, and so I think that's the source of a lot of it. And a lot of it is comparing the high cost of the reverse mortgage compared to the forward mortgage closing costs that we're mostly familiar with. But that's comparing apples to oranges. The traditional forward mortgage is a recourse loan, meaning that if the loan balance grows higher than the value of the home, you still owe that deficiency. With a reverse mortgage, at least the most common type of reverse mortgage, which is the home equity conversion mortgage that is federally insured by FHA, it is a non-recourse loan, and the insurance has a cost, and it's a significant cost, and that adds to the closing costs. So many will look at those costs and say that's not what we're expecting, and
Yeah, definitely. So when should someone consider, seriously consider a reverse mortgage?
Well, I would say anytime you have significant equity in your home, I would consider it. And that goes for people that can see the writing on the wall, looking into the future, trying to go through their financial planning, and they realize that they've got significant risk. Of course, they should be looking at the benefits and the flexibility and all of the potential that a reverse mortgage provides. But even more, well, equally so, people in the mass affluent, and that definition of mass affluent varies from people with 500,000 to a million. I would say it's more like 500,000 to 2 million, but easily in the 2 million bracket, you should still look at the benefits of a reverse mortgage, depending on how your assets are allocated. If most of your assets are in 401k type or IRA funds that are going to be 100% taxable, and you're mostly invested in equities, then you will want to protect against the market downturns that are inevitably occur. Having a buffer asset that the reverse mortgage can provide gives you so much more flexibility. And as most of us in this space know, it is very, very difficult to anticipate what curveballs life is going to throw. Certainly we would not be surprised if we have high long-term care costs. Wouldn't be surprised if somebody in the family really needs help. You don't want the only option available to you to be that 401k fund that is going to be your primary source for income as you go into retirement. So I think that answers the question. That there are not too many of us that have a home and have some equity that shouldn't consider a reverse mortgage.
So what happens when the homeowner passes away? And basically, you would think that maybe the heirs, the beneficiaries, probably aren't going to get anything. Is that true?
Well, it again depends on the loan balance. If the loan balance in this reverse mortgage loan has grown to almost the value of the home, or even exceeds the value of the home, that's where the FHA insurance comes into play. The most that is owed from the borrower is the value of the home. So if the loan balance is much greater than the home value, well, it's just a deed in lieu of foreclosure type situation, or you just turn over the keys and FHA takes care of that loan balance, but they would own the home. If that loan balance is less than, say, 95% of the appraised value, then the heirs would look seriously at selling the home, and the most that they would have to pay for that home is 95% of the appraised value. And if there's a difference, that loan balance is less, of course, they have profit from that. And remember that, again, for the case of the mass affluent that is really wanting to enter into the reverse mortgage loan, they may be primarily looking to have a line of credit that's going to grow at exactly the same rate as the loan balance. So a lot of clients are going to want to have a very, very low balance. We recommend that it not be less than $1,000, just to give you some wiggle room there. But that line of credit may be quite large, and of course has the potential of being much greater than the value of the home. And of course, they would have a lot of equity still remaining in that home, so they would certainly want to either buy it or just close out the reverse mortgage loan and keep the home, inherit the home, or they could sell it. But typically, there's going to be a significant loan balance. The heirs would just refinance that home, pay off the HECM loan or the reverse mortgage loan, and that would be it. They would still inherit most of the equity or all of the equity that remains.
So does that still the same if the homeowner can't stay home anymore and they have to go to, assisted living or long-term care?
Well, that is one of the triggers that makes the loan due and payable. So if it's a couple, for example, and one of the couple has to move to some sort of assisted living type situation, that remaining spouse can still live in the home with no monthly payments due toward that loan. But when the last spouse has to leave or needs to leave or decides to move, then that would trigger the due and payable, and the home would have to be sold if they don't have the resources to pay off that loan.
So can a reverse mortgage be refinanced if circumstances change?
Very much, of course, yes, it certainly can, and it's a common thing. For example, if we took out the reverse mortgage loan today with the interest rates what they are, and then let's say 5 years from now, 10 years from now, your home has appreciated a lot, that would be a good reason to make it change or refinance. Likewise, if the prevailing interest rates change, and let me back up a little bit and explain the loan balance, that the maximum loan balance allowed from the typical home equity conversion mortgage loan, the HECM loan, is based on the age of the borrower and also the value of the home, of course, and the prevailing interest rate. The interest rate on the most common HECM loan is an adjustable rate mortgage, and that's tied to the 10-year treasury, and so it's a modest interest rate there, and there's typically a margin that the lender gets as part of the profit, that what they need for their expenses and so forth, and that's typically about 2% over the 10-year CMT treasury rate. If that interest rate is high, then the maximum amount of the loan is going to be relatively low, or it's going to be lower than if that interest rate was very, very low. And also, if your home value, or if your home value is $500,000, you're likely going to only be able to borrow about 40% if you're 70 years old, let's say. If you're older, 75, 80, that percentage will be higher. So as you get older, you automatically would be able to borrow more, but also if your home value has gone up, that loan value will be higher. So the bottom line is you can get more equity out if you refinance in those types of situations. Sorry if that was a little lengthy, but
And so Mike, if somebody wants to talk to you more about reverse mortgages, how do they find you?
well, my phone number is 713-553-3047, and you can reach me by email at mritchie at C as in Charlie, the number 2, financial.com.
And so perfect. And so Mike, I sure appreciate you being on the show today, and we look forward to having you on again soon.
Thank you very much, Kim. Have a good weekend.
You too.
Bye now.
Thanks for tuning in to this week's episode of Life Happens with Kim Hegwood. Be sure to tune in every Thursday at 10 a.m. wherever you listen to your podcasts as we navigate through the challenges that emerge as life happens. The content of this podcast does not establish an attorney-client relationship or constitute attorney-client privilege, legal, medical, financial, or any other professional advice.